All right, myself, we're gonna do a late night study session. It's 9:50 p.m. No, I don't want to study, but I gotta get it done, and I got some reading I gotta get done. So we're gonna get some reading done, and then boys shower at the end and head to bed. It's a Friday night too. TGIF. I'm on chapter 15-2, the start of chapter 15. Collecting a mutual fund. Welcome live. Doing a little study sesh. Mutual funds. Chapter 15-4. We're trying to get this chapter done in the next 60 minutes. Just gonna return between different types of mutual funds. Money market funds. Check this. So, risk and return between different types of mutual funds: money market funds, mortgage funds, bond funds, cap balance funds, dividend funds, equity funds, real estate funds, specialty funds. The most important thing to remember is that the risk level or volatility in returns of a mutual fund is directly related to the risk level or volatility in the returns of the securities it holds in its investment portfolio. It's directly related to the risk or volatility in the returns of the securities it holds. This means that funds of the same type, for example, equity mutual funds, cannot be expected to have necessarily the same level of volatility. In addition, it is possible that funds generally regarded as lower in volatility may actually have higher volatility than others. For example, zero coupon bonds are very volatile. It is likely that a zero coupon bond fund will be more volatile than a bond fund, especially in a period of volatile interest rates. What is the source of this volatility? Why does the return earned from security not stay the same over time? Simple answer is that when there are more buyers and sellers of a particular security, to be a successful buyer, you must outbid your rivals. This bidding activity pushes up the price of the security, which affects the returns. Similarly, when there are more sellers than buyers, the successful seller must be willing to let his security go at a lower price than the other sellers. This will push the price down. There are always investors in the marketplace looking for money-making opportunities. Investors may suddenly decide that a given stock is trading at too low a price and put in orders to buy in an expectation that the price will rise. They may have just received that information about a new product that the company has developed or a new acquisition, and they believe that this new product or acquisition will increase the company's future profitability. Although other factors may change a security's price, new information is the key. When new information about a security becomes available, investors' beliefs change about the value of the security, and buying and selling occurs. If the new information is favorable, the price of the security will go up. If unfavorable, then the price will move down. In this process, some investors have better information than others, and often the results of superior analysis. Some securities are very sensitive to new information. For example, the stock of a high technology company will react strongly to new information about the company's products. A new discovery can result in a substantial price increase. Similarly, the price of a biotechnology firm may be negatively affected by the news that a drug has failed to obtain approval by regulators. Other securities are not particularly sensitive to new information. For example, although the shares of the biotechnology stock may be negatively affected by bad news, bonds of that same company may not be affected to the same degree. If securities price is affected by new information, and if new information arrives frequently, then its price will tend to be volatile, and so will the returns that it generates. This source of volatility is specific to a given security and is known as unique risk. When more than one security is held in a portfolio, these unique risks tend to cancel each other out. Well-diversified portfolios, those consisting of a large number of securities, will almost completely eliminate unique risk. Even well-diversified portfolios have risk. However, after the unique risks are eliminated through diversification, you are still left with market risk. For example, the rising interest rates tend to make investors uncertain about the future profitability of all stocks, which tends to depress the stock market as a whole. Market risk cannot be eliminated through diversification. All mutual funds except money market funds have some amount of market risk, depending on the composition of the portfolio. If a mutual fund tries to specialize in a few good bets in the hope of earning higher returns, it will be subject to unique risks as well, due to the lack of diversification. Other sources of volatility discussed earlier in this course and reviewed in table 15.1 have to do with the specific nature of a security. Sources of volatility in mutual funds. Unique risk, also called specific risk. Source of risk, sensitivity of a security's price to new information leading to changes in demand. Ways to reduce risk, diversify. Default risk, the unique risk that a bond coupon will not be paid. And avoid specializing in corporate bonds. Market risk, also called systematic risk. Changes in the overall market affecting an entire class of securities. None. No one can avoid market risk. Exchange rate risk, changes in the relative value of the currencies of the countries of investment. Hedging. Interest rate risk, changes in interest rates leading to changes in fixed income security prices. Avoid specializing in fixed income securities. The point is that the volatility of any security or mutual fund is the result of the interplay of a number of risk factors. Because mutual funds are made up of different securities with different risk factors, the volatility of the funds are also different. 15-6. What are the steps in selecting a mutual fund? Analyzing volatility is one of the key steps in the process of selecting a mutual fund. To select individual funds within each mutual fund category, it is recommended that you follow a step-by-step process similar to that shown in 15.2. Steps for selecting a mutual fund. Refer to sources of published mutual fund performance data. Identify funds with appropriate investment objectives. Look for funds with the best long-term performance. Among the best long-term performers, look for best performance from year to year. Among best year-to-year performers, find those with lower volatility. Yeah. Among funds with low volatility, find ones with where the current investment manager is responsible for good performance. Compare fund facts documents and compare prospectuses. Examine fees and charges. Analyze the size of the mutual fund, make the decision. Each step is taken up in more detail in the sections that follow. Research the performance data. There are numerous sources of data about mutual fund performance, many of them internet-based. The Globe and Mail newspaper provides a twice yearly 15-year mutual fund review. Yo, what's going on? Twice yearly 15-year mutual fund review in February and November. See theglobemail.com. Morningstar Canada. Morningstar.ca is another commonly used source of objective data about mutual fund performance. These are blue light blocking glasses. Depending on how deep you dig, data for each mutual fund could include a return indicator, volatility indicator, whether the fund is eligible for deferred tax plans, total assets, net asset value per share. the distributions paid, management expense ratio, sales fee structure, quartile rankings over 3, 5, and 10 years, and performance data over short and longer term, along with benchmark comparisons. In many cases, a graph is included showing how an investment of 10,000 in a particular mutual fund has done over the period since inception, and it includes the appropriate benchmark comparison to show whether the fund has performed above or below its benchmark. What's wrong with you? Definitely feeling tired. Late. It's late. It's 10:07 p.m. where I'm at. Focus on appropriate investment objectives. After gathering performance data, you and your client must focus on funds that are similar in terms of investment objectives. It is improper, not to mention misleading, to attempt to compare the performance of funds with different objectives. For example, money market funds are expected to offer lower performance than equity funds over the long run, and also to be much lower in risk. Comparing a money market fund with an equity fund in terms of performance, therefore, would not be appropriate. Time is 10:08 p.m. Pacific. Finding that a particular equity fund is better performing than a particular money market fund will tell you nothing about the performance of the equity fund in relation to its risk category. Nice, we're halfway through this chapter already. Wow. Focus on best long-term performance. After finding funds with appropriate investment objectives, look for the funds with the best long-term performance. For example, if the ABC Equity Fund is a 10-year compound rate of return of 18.1%, it means that an investor who bought that fund 10 years ago and held it until the record date of the listings would have earned an average annual return of 18.1%. This includes the reinvestment of all dividends, those distributed by the fund, as well as dividends that reflect the capital gains earned on the mutual fund's portfolio of common shares sold at a gain. 18.1%. Could be. Oh, just trying to get some reading done. Minds FM. Time to get the rest of our study session done. I can't believe it only says it's been 24 minutes. Crazy. All right, hang on. Hang on. There we go. That's a better angle. Okay. What the? Okay. Where were we? Where were we? Yeah. This lack of long-term data may be a problem. Clients seeking good long-term performance. A client seeking good long-term performance, a goal consistent with an investment in an equity fund, will find it difficult to judge the potential for long-term performance of a fund that has been in existence for such a short time. Even if short-term performance is good, there's no guarantee that in a different phase of the economic cycle, the fund will continue to do so well. A fund with a strong 10-year performance, on the other hand, has usually been through at least one complete market cycle and perhaps two. An equity fund with less than 3 years for performance data does not give a good idea of how the fund will perform over the long term. When comparing mortgage funds as suitable shorter term investments, however, 3 years would be a more acceptable period. Performance data for both bond funds and equity funds should be long enough to cover one complete market cycle at least 5 years. Focus on best year-to-year performance. 8:08 a.m. That's early. After finding comparable funds with good long-term performance, look for funds with the best performance from year to year. In comparing two funds, the one with less variation in simple rates of return from year to year is a more consistent performer. The simple rate of return is the return earned by the fund over a given year or period. Simple rates of return are useful for looking at the consistency of returns. Consistency is important. Although equity funds are intended for the longer term, if liquidity is needed, the fund with a more consistent performance is less likely to be sold at a loss. Simple rates of return also tell effectively how well a mutual fund performs when the markets have turned bearish, anticipating a fall. Some investors focus on this aspect of a mutual fund's performance. For example, if a mutual fund went up 25% a year when the overall market increased by 27%, but went down 25% when the overall market declined by 20%. Oh, ZB, welcome live. Thanks for tuning in. 7:17 for you, like AM as well. It's crazy. Oh yeah, but went down 25% when the overall market declined by 20%. The fund may not be an ideal investment for a conservative client. Such a client would prefer a fund that went up by 18% in the first instance, for example, but went down to 8% in the second, offering greater protection on the downside. Focus on good performers with lower volatility. Some sources indicate the relative volatility of mutual funds and are based on the fund's standard deviation of the return. For you've been awake for like 3 hours? Holy. So you've been up since like 4:17 a.m.? That's crazy. Recall that standard deviation is a statistical measure of risk. The larger the standard deviation, the greater the volatility of returns, and therefore the greater the risk. The more a return departs from the mean, the higher the deviation, and thus the higher the volatility. In general, for funds with the same long run compound rate of return, those with lower volatility should be preferred, all other things being equal. Measures of volatility other than standard deviation include ratios such as the reward to risk ratio and the Sharpe rate ratio and beta. Reward to risk ratio. Some published sources provide a measure that shows return for risk. This measure is called the reward to risk ratio. In its simplest form, it is just the return earned by the fund over a period divided by the standard deviation. Reward to risk ratio. is the fund return divided by the fund standard deviation. For example, a fund might earn a 1 year return of 14% and have a standard deviation return of 28% per year. The reward to risk ratio is 0.5. This means that this fund earns 0.5% for every 1% of standard deviation. If another fund had a ratio of 0.6, you would say that that fund was able to earn a better return for that same 1% of standard deviation. Is this is this your first time being live? No, it's not. I've done tons of lives. If you subscribe to my channel, you can double check, or you can check out my channel after this. I do workout lives, lunchtime lives, study lives, meditation lives. I'll be doing a meditation live tomorrow morning as well. Have you ever gone live before? I'm on Canadian time and it's 10:20 p.m. for me, and I'm studying my mutual funds course. Check this out. On ratios. Yeah. Yep. Reward to risk ratio. Calculating ratios. Oh, you're never gone live? Do you have a YouTube channel? Yeah, I love going live. I go live every day, 2 to 3 times a day. This is my third live today. Okay. The return on ABC fund was 9.8% last year, while the standard deviation was 5.5% over the same period. What is the reward to risk ratio for the ABC fund? So yeah, reward to risk ratio 9.8 divided by 5.5%. The reward to risk ratio is 1.78. That means that ABC earns 1.78% of return for every 1% of standard deviation. Cool. Nice. What's your channel? Mine is Mind, Body, and Soul Optimization. I do workouts, I do mindset training, how to develop better mindset, so personal development, podcast episodes, and then I do soul meditation to be centered. Yep. Tomorrow morning I'm doing meditation. So probably around like 8:30 a.m. Pacific or something like that. 9 a.m. Pacific. Yeah. Sharpe ratio. As indicated in the previous chapter, the Sharpe ratio shows how well the return of portfolio compensates the investor for the risk taken. It is often used to compare the performance of mutual funds among themselves and against benchmarks. If a fund manager is being measured against a benchmark, the portfolio's Sharpe ratio can be compared to the Sharpe ratio of the applicable benchmark. The higher the Sharpe ratio, the more return the portfolio got for the same level of risk. Pacific Standard Time, 8:30 Pacific Standard Time, so 11:30 Eastern. Ah, fund managers being measured against benchmarked portfolios. Sharpe ratio can be paired to the Sharpe ratio of the applicable benchmark. The higher the Sharpe ratio, the more return the portfolio got for the same level of risk. A group of portfolios can therefore be ranked by their risk-adjusted performance. A mutual fund with a Sharpe ratio greater than the Sharpe ratio of the benchmark outperformed the benchmark. A mutual fund's Sharpe ratio that is smaller than the benchmark signals underperformance. A negative Sharpe ratio means the mutual fund had a return less than the risk-free return. Example: Canadian equity fund called DEF had an average fund return of 6% and a standard deviation of 5. The Canadian equity benchmark had an average fund return of 8% and a standard deviation of 10. The average risk return was 1%. For this example, Sharpe ratio of the fund and its benchmark calculated below. Both the fund and the benchmark had a positive Sharpe ratio, which means that both had an average return greater than the average risk-free return. However, the DEF risk-adjusted return was higher than the benchmark's risk-adjusted return. That means that DEF was able to earn a greater return for each unit of risk compared to the benchmark.
Oh yeah, S- San Antonio. Is that it? SA San Antonio, Texas. Is that right? Oh, South America. South America. Right. Yeah, had a higher rate of return for each universe compared to the benchmark. Even though the benchmark produced a higher total return, the benchmark employed twice as much risk to do so. Is strong and tough. Oh, South Africa. Nice. Sandra Horn. Sorry. South Africa. That's awesome. You're from South Africa. That's cool. I've had a few people tune in from South Africa when I do these late night lives, which is sweet. So yeah, if you like meditation, if you like workouts, if you like meal prep, um, lunch with me, study with me, hit subscribe. Appreciate it. Okay, I just want to see how much gas I have left in the tank. Yeah, I've heard South Africa is amazing. I want to check it out. Me and my wife want to check it out. It looks like an awesome place. Like beautiful beaches and food and weather. Monkey bar kid. Yeah, I've heard it. Yeah, I've heard it's nice. Okay, let's see how much we got. So we're in 515-9. I'm just gonna make an update to where we're at. Oh yeah, it's 10:27 p.m. So we'll see how much gas I have left in the tank here. We're about almost there. 15-9. Oh, 6 more pages. Okay. Okay. Here we go. Both the reward to risk ratio and the Sharpe ratio give an indication of how successful the fund has been in earning a return per unit of risk, standard deviation. The beta. The beta and beta coefficient discussed earlier in this course compares the volatility of an equity fund to the volatility of a stock market as a whole. Any equity fund that moves up or down to the same degree as the stock market has a beta of 1. Any equity fund that moves up or down more than the stock market has a beta greater than 1. And an equity fund that moves less than the market has a beta of less than 1. Thus, the higher the beta, the higher the fund's volatility compared to the stock's index volatility. The lower the beta, the lower the fund's volatility compared to the stock's index volatility. The best Table Mountain. Oh, V&A Mall. There is a lot of fun beaches. Nice. Good to know. Okay. Hmm. Thus, the higher the beta, the higher the fund's volatility compared to the stock's index volatility. The lower the beta, the lower the fund's volatility compared to the stock's index volatility. Focus on funds with successful investment managers. After isolating high performing funds with low volatility, look for funds in which success can be attributed to the performance of the current investment manager. Good performance is the result of a combination of luck and good management. If good performance persists over a long period, it's likely that good management is the cause rather than the luck. Over short periods, it is hard to say. There are issues with manager data. First, few funds have retained the same managers over long periods. Second, many funds are managed by investment advisory firms, and there may be no way of knowing which individuals have been responsible for the funds. If reliable data are available, however, a fund with good performance over the long run with the same manager in charge suggests that the continuation of good performance is partly due to the manager's skill. Oh, how long have I been studying for? Since March 21st. But specifically today, just about 30, yeah, 40 minutes. Yeah, I'm doing the reading. hmm It's like 438 page textbooks. I do all the chapter reading. There's 18 chapters. They're about 30 pages each, 15 to 40 pages each. And then I got a final exam. Yeah. Yeah. That's online proctored at the end. But I have to do all my quizzes and all that, which I'm going to finish up those. I have been doing the quizzes after each like 3 chapters. I just haven't done the latest one because I just want to power through the rest of the reading and get it done. There are two issues with manager data. First, few funds have retained the same managers over long periods. Second, many funds are managed by investment advisory firms. Um, and there may be no way of knowing which individuals have been responsible for the funds. If reliable data are available, however, a fund with good performance over the long run, with the same manager in charge, suggests that continuation of good performance is partly due to the manager's skill. One additional performance measure to consider is the alpha on a fund. Alpha is a measure of the manager's performance. If alpha is positive, the manager has produced more return than predicted by the manager's beta, and thus the manager has added value to the portfolio. The greater the alpha, the better the manager has done. On the other hand, an alpha value of 0 indicates that the manager has achieved only normal performance, meaning the manager has added nothing. If alpha is negative, the manager has underperformed for the level of risk taken on. And another reason I love doing lives is, hey, good morning, Dabiga, is that it's been helping me grow my channel faster than YouTube Shorts. And YouTube Shorts are just the editing so much work. And then live, I can be raw, I can be real, I can be unscripted. Um, because shorts are very sensitive to pacing. So, and most people only watch 8 to 15 seconds or 8 to 30 seconds, and that's super short. And it's hard to edit that down and trim that down to something that people actually want to watch. So that's why I do lives, because I can connect with you on a human level. I can be authentic, I can be real, I can be raw. And that's who I am at the core. And that's why I love lives. And that's why I show up every day doing 2 to 3 lives a day, because that's how you're in a way you're getting to know me on a personal level, right? With a YouTube short, you're not really getting to know someone on a personal level. You're getting to know how well they edit, really, at the end of the day. And I just find it draining, the YouTube shorts. Um, like as long as I keep my edits to a minimum, I like them. And I do them well, and I can do a bunch. But not my main focus. I want to do long form content as the main focus. Let's try and get to the end of the chapter. Give ourselves a few 15 more minutes. Compare fun facts documents and compare prospectuses. At this point in the selection process, you and your client have reduced the field down to only a few competing funds. Now is the time to get the fun facts documents and prospectuses from the candidates. Even if funds are in the same category, there may be significant differences in investment practices and in the potential makeup of the portfolio. Your client will still want to make sure that the fund they select provides the best possible match to their investment objectives. These disclosure documents will provide complete data on sales charges, valuation, minimum investment requirements, and so forth. This information can be quite relevant. Some funds, for example, require initial investments of 100,000 or more. Crazy. We're almost there, Mindset Fam. 5 more pages. Examine fees and charges. Performance data reflect management fees and operating expenses charged to the fund. They do not include charges paid by individual investors to the fund. Yeah. However, such as acquisition and redemption fees. If the investment time horizon is short, high sales fees will substantially reduce the returns that can be earned. Management fees are included in return calculations. While higher management fees may be easier to ignore in good times, they can lead to higher capital losses in poor times. All things being equal, it is better to choose a fund with lower MER, management expense ratio. The same reasoning applies to sales fees. If liquidity is a concern, sales fees can end up being very costly. For example, if a client holds a mutual fund investment for 10 years but had to pay a 5% acquisition fee, you can think of that fee as being spread out or amortized over the life of the investment. If the fund has performed well, the sales fee will not have too bad an impact. Hmm. However, if the client is forced to sell after 1 year, the fund would have had to earn 5% after management fees and expenses just for the client to break even. Oh, hello, show Ibrahim 4. Yeah, absolutely. Appreciate being here. The same logic applies to funds with redemption fees, but to a lesser extent. Most redemption fees decline over time, such that a fund held for the long term will not charge a fee upon redemption. However, if the fund is sold prematurely, those fees could be quite high. Most reported sources of data indicate whether the funds charge acquisition and redemption fees. These details are available in the fund facts document and prospectus. If the fund is expected to be a long-term investment, a redemption fee may be more beneficial to the client than an acquisition fee. Keep in mind, though, that a redemption fee reduces the flexibility of choice when a client wants to get rid of the investment sooner than expected for any reason. For funds with similar overall characteristics, select the one with the lowest MER over a long investment time horizon. A high MER can result in a much lower amount of accumulated returns. MER is the management expense ratio. Convert your religion, I challenge you. No, I'm good. Analyze the size of the fund. One factor in selecting a mutual fund is the size of the fund relative to other funds in the same category. Many people share the belief that as mutual funds grow beyond a certain size, their beneficial economies of scale start to break down. Very large mutual funds may be at a disadvantage compared to smaller funds because they cannot shift their large portfolios as rapidly. Also, large purchases or sales in the relatively small Canadian market tend to have an impact on the price of the securities the funds are trying to buy or sell. Many investors shy away from newer, smaller funds because they have been untested in the market and have not been gone through the full market cycle. Others, however, feel it is best to take advantage of the momentum that newer funds offer before they become too large or perform less well. Hey, Nana, what's going on? No, all good. I'll pass, Ibrahim. No. We're here to study, we're not here to rant. No, thank you. There we go. All right. We're almost done this next chapter. Nana, you'll be proud of me. Shut up and get out of the chat. Thank you, Nana. Appreciate it. Oh, Like I was being so annoying. I'm just trying to get the studying done. Just check this out. Check this out. We're at so 15-10. So chapter 15 out of 18. We got 5 more pages to go. So we're at analyzing the size of the fund. Yeah. All right. There we go. Yeah, chapter 15 of 18. We've been grinding. We've been grinding. It's been slow, but steady. Okay. So chapter 15, 16, 17, 18. So 4 more chapters. Okay. Where were we here? Okay. Yeah. Yeah, here we go. Make the decision. Making the final decision involves selecting the fund with the best long term performance relative to risk. Volatility obtained by the manager responsible for the fund's performance. You and your clients may end up selecting a fund in which you have great confidence. In many cases, investors must make trade offs among the factors on which they base their decisions. For example, the fund with the best long term performance might be an inconsistent or volatile performer, have relatively high sales fees, or require an initial investment far beyond investors' means. After a fund is selected, there is no guarantee that the fund will perform as anticipated. The fund manager might change. The economy could enter a phase that a previously high performing manager might not understand as well, or the manager could even have a string of bad luck. The weakness of any selection process is that investors are prisoners of past data, and the future is never quite the same or entirely knowable. What other elements should be considered when analyzing and selecting mutual funds? You will find mutual funds in most asset classes. The Canadian Investment Fund Standard Committee, CIFSC. Oh, all 18 chapters today? Yeah, no, definitely not. Uh, but I will try and get chapter 16 done later today if I got time. But me and my wife are going to be going out, visit friends and stuff. So probably a little bit tomorrow morning and then a little bit on Sunday. What is this rubbish? Ibrahim. There. I don't know. I've blocked him. I've deleted his comments. Guy's like insane. Get rid of him out of the chat. There we go. Where were we? Okay. You'll find mutual funds most asset classes, the Canadian Investment Fund Standard Committee, CIFSC, the body that oversees mutual fund classification, lists more than 50 categories containing more than 7,000 funds. The CIFSC tracks investment funds on a security by security holding basis. For purposes of category assignment, security types are grouped into 5 broad asset classes. Thank you, Nana, for goodness sakes. Oh, I don't know what his deal is. He just keeps speaking jungle talk. Cash, fixed income, equity, commodity, and other. The CIFSC calculates all holding figures and other portfolio statistics used for categorization based on a time-weighted average over a 36-month period, with an emphasis on the most recent 12 months of data. Theoretically, the client can buy any specific exposure in equities, Canadian, US, sector, dividend, international, global, emerging, market, small cap, large cap, index, fixed income, Canadian, US, foreign, high yield, balanced, tactical, Canadian, global, or money market. Canadian, US funds. Have a lot of free time control. Yeah, 100%. Mm. This isn't relating to study with me, so this is removed from the chat. Got to be related to studying techniques, etc., etc. It's not related to that. Don't want to hear about it. Where were we there? Given, oh yeah, here we go. Given the enormous breadth of choice, how do you select appropriate mutual funds and create a portfolio? This becomes more than a simple investment decision. Buying a mutual fund means having a business relationship with the management firm. Therefore, qualitative as well as quantitative elements must be weighted. Assuming a risk assessment is completed and an asset allocation is in place, you must then consider four elements of mutual funds before selecting suitable candidates: people, philosophy, process, and performance. So close. Oh man, I'm hitting a wall. Okay. I need some water. Completed a book today. Hey, good for you. Feel pretty good after reading through It Was a Murder Mystery. Hey. Um, like that's awesome that you're getting back into your reading. It's great. Hopefully I've been providing some inspo. Because hey, I know reading's not easy. It's hard on the focus, but it strengthens your focus if you keep doing it. Right? It's like any habit. I might lose my voice, but I find speaking aloud helps me read. Trying to be quiet, a little bit more quiet because my wife's asleep, but we're almost done. We're almost done. Let's try and power through. Just a couple more pages. People refers to the personnel of the investment firm that manages a particular fund. Yeah. Portfolio manager investment team. Oh yeah. People refers to the personnel of the investment. Yeah, managed particular fund. Ideally, a fund should be headed by a portfolio manager with several years of experience and backed by a team of analysts, client service staff, back office staff, and technology. Excuse me. An ideal organization should have strong, stable ownership and be well capitalized to fund future growth. The portfolio manager should have an equity stake in the firm with performance bonus incentives. Portfolio manager investment team. Evaluation of the portfolio manager and the investment team may be the most important part of the mutual fund assessment process. Without a good portfolio manager leading a competent investment team, all other factors become irrelevant. Portfolio managers should have several years of experience successfully managing money in their area of specialization, long enough to encompass at least the ups and downs of one market cycle, generally 5 years or more. Also, it is helpful if their experience matches the investment's specialization in the types of funds that clients desire. Portfolio managers should be able to focus largely on investment management. Managers are responsible for a broad range of duties beyond investment research. There are ethical and regulatory compliance requirements and business issues, plus client service, marketing, and sales. Good investment management firms have enough resources to address these needs and allow their investment professionals to focus on portfolio management. Mm, Okay. Ownership. You should sleep. You look kind of tired. 100%. I think I might leave it there. My eyes are bloodshot. I tried to push through. Oh, look at, yeah, eyes are definitely bloodshot. So I appreciate you noticing. And but hey, we got to literally at the bottom here of 5-11, and we're gonna start 5-12. So there's literally like four more pages, and then I'll do some. If I have some time in the morning, I might have some time in the morning because I gotta get our dog's haircut at 10 a.m. and I want to sleep until at least 8 a.m. because I'm going to bed late tonight. So, and then, yeah, and then because our dog will be like 2 hours of haircut, I want to do some cardio, like some jump rope or treadmill until or boxing until so that'll be like kind of like a study and then do boxing or boxing and then study again. Yeah. So we're gonna get it done. We're so close. We're so close. And you're so sleepy. This week, I'm not gonna lie. This week has been a grind and I've been so sleepy. But yeah, um, I will try again tomorrow. And again, we're gonna get the rest of it done. We're so close. 15-10. So 15-11. I'll just mark that off. 15-11. Literally at the bottom. 15-11. Beauty. There we go. Okay. Nighty night. Peace, mindset fam.